But we do that in a way to change the lives of the owners of those businesses and their kids. And I think that's what we're looking for.
Welcome to Alt Investing Made Easy, where we explore the complex world of alternative assets. I'm Roland, a securities attorney, investment advisor, and your co-host.
And I'm Sarah, an investment advisor and corporate attorney, and your other co-host. We'll guide you through real estate, private equity, and more, making complex topics accessible.
Tune in for insights that empower your financial journey.
Let's make alt investing easy, one episode at a time.
Welcome, everyone, to Alt Investing Made Easy. Thank you for joining us today. Today, we're very pleased to have with us Carlos Lowenberg, founder of Masterpiece Capital, based in Austin, Texas. Thanks for joining us today, Carlos.
Thank you. Nice to be here.
Hey, Carlos, it's so great to have you here. We were talking before we started the recording about how long we've known each other, and we don't have to say the specific number of years, but it's great to reconnect. And Carlos, you have Masterpiece Capital. It's an investment advisor firm in Austin, Texas. Maybe tell us a little bit about your investment advisor practice.
Sure. Yeah, it goes back when we first met. Was doing this. We focus on entrepreneurs and business owners and their families, and generally, it's rooted in helping them optimize their situation. So, typically, that involves investment advice, a lot of tax advice, and now sometimes asset positionings for things like creditor protection, and business value enhancement as well. So that's really where we're focused on. We're specialized. We have a fewer number of clients than most businesses our size have because they're fairly wealthy on average.
And so it's primarily, I guess, a fee-based practice versus a transaction or commission-based.
Yeah, for sure. It's fee-based. We're an RIA, fiduciary. Our investment advice is all fiduciary advice. The key here for us is, you say transactional, we say not transactional. And we're focused on transformational relationships, if that makes sense. That's what we're looking for. And any relationship for us that's not going to be transformational is not going to be a relationship.
What do you mean by transformational relationship?
Well, when I get involved with a family and their business, I aim to transform what they're doing. In other words, together with them, aid them in achieving some very big things. It's great to save millions of dollars in taxes. It's great to divert money from the government to what might be a family foundation. But we do that in a way to change the lives of the owners of those businesses and their kids. And I think that's what we're looking for. We're looking for that opportunity, and it's long term. I have clients that I've had since Roland and I have known each other last century. So, that's our focus is transformation.
Sarah, I bet you can guess where my mind went to immediately, right?
I don't know if I can always guess what you're thinking, Roland, but go ahead.
Well, in this context, for sure, what we talk about on the podcast. Sure. Yeah, maybe tell Carlos a little bit about read my mind. Tell me what I'm thinking.
Well, what we talk about here are alternative investments, and we're trying to focus on education for people because there's so much going on in the world of private securities. And naturally, there's a connect, which is I read one of your recent articles about what's called a mid-market millionaire, which is, I think you identified as a family between $10 million to $100 million in net worth. Mm-hmm. And of course, that sounds like a tremendous amount of money to a lot of people, and it is indeed a lot of money. However, in the world we live in today, there's so much focus on the ultra wealthy, people counting their wealth in billions, that segment maybe gets a little bit lost. And I think that there's a correlation with the work we do with some of our clients on helping them structure their private investments and their alternative securities or their private securities, because those people are on that path up to that $10 million and above. They tend to be entrepreneurs, and they tend to need services like what you offer in due course. And so I'd be interested to hear from your perspective, what do you consider, how would you look at what we call alternative investments, essentially anything that's investing outside of public equities and cash and bonds?
Yeah. I mean, that's for most people, the universe is public equity, like you said, bonds and cash. And that's what they're limiting themselves to. And sometimes they have to. But
Right.
then when they're in the high net worth area, they're accredited or qualified investors, they can do more. And what I typically do is I have a whiteboard somewhere close to me or a notepad, and I draw a picture. Let's look at this as your meta asset classes. There's public equity and public debt. So this is a quadrant, right?
Mm.
And there might be some real estate involved in both of those. Sometimes private debt's a lot around real estate. Sometimes equity is too. On the other side is private equity and private debt. Now, if you look at the world of investments and the world, if you're online or if you're looking at watching television about this, you'd think that everything was in the first two. But something like 75% of the world's assets are in the right two.
Mm-hmm.
And so if you're an investor, you're missing out on those right two. So who is investing in those right two? Well, it's institutions, high net worth individuals, and people that have generally are more goals focused than just I need to save 10% of my income every year.
Mm-hmm.
So when you can match private, so you're looking at the right side of this quadrant, that's where you start to begin to find opportunity that institutions are taking advantage of, and high net worth, ultra high net worth people are taking advantage of. And there's a wider universe. In fact, the public equity universe has shrunk in the United States.
Yeah.
When I was first in business, I think there was 9,000 or so public companies, where some of them were very small. But now there's 4,500 or 5,200. I can't remember the number is, but I'm going from memory. But there's almost half. So there's more money in those. So it's gotten heavy over there, and of course that's why I think you see such high, high PE ratios.
Yeah. Thank you I think Roland was trying to write down your diagram as you were explaining it.
Taking notes to put it down in my brain. That is a recurring theme for sure that we've talked about. We've been doing this podcast for about a year now, and one of our earliest episodes was talking about, private versus public securities markets. And, again, just like you said, the news talks about the public markets and then how big the private markets are. But I like what you just said about the opportunities and the differences and having more of if you do have more of an intentionality in your investment program or want to exercise greater degree of control, there are some huge advantages to working in the private markets versus public.
Mm-hmm.
So, I mean, anything you had to respond to that?
Yeah, I mean, I think that it's one versus the other. What really is a liquidity issue, right? I mean, the public markets, first and foremost, this is by law, have to be public. I mean, have to be liquid. Excuse me. Yeah. That's, of course, the first one, but they have to. I mean, the liquidity is the issue. In other words, it's kind of like in the airline industry. Being on time is great, but safety's number one, right? Yeah. So in the public markets, liquidity is number one, and then it's the other things that you want from an investment. Whereas in the private markets, the other things become more important than liquidity.
Right.
And the liquidity is just one of the how would you say it? One of the knobs that you turn, or one of the levers that you're pulling. It's not the lever that's pulled first. It's not the big one on the table. Right. Yeah.
Well, and I think also you just indicated an interesting potential risk. Not to get into the public markets, but if there is a concentration and you've got larger and larger organizations that are built, that are where we put all of our money in the public markets, the economy as a whole has grown. And so there's a risk that you're actually missing out, not just on good deals and different kinds of things if you don't participate in the private markets, but but you also wouldn't have, you'd be out of balance because you would, I think at a certain point when you have enough money and you can afford illiquidity, which is, I think what you just said, which is if you have enough of a net worth, then you can put more money into illiquid assets because you don't necessarily need them for your daily life issues that come up. But it strikes me as just from a balance perspective and a risk allocation that, the old true, well, we learned decades ago, didn't we, that putting all of your money into one company or into a pension program with one company can be a real risk for your later life.
Yeah. No, I would agree. I think that missing out on private assets does add risk. And I think that you're seeing some movement towards allowing more people to invest. I mean, we're seeing the democratization of private assets slowly over time, maybe speeding up right now because of the risk, the knowledge about that risk that's permeated the society, basically.
Yeah, that democratization of capital is a thing that we've talked about too. And I think, the SEC's come out recently with maybe allowing people to take a test to qualify as being accredited. And I know that's not final yet, but there is a trend in that direction to allow more and more people to invest in private assets than has been the case in the past.
Mm-hmm.
Yeah. Yeah. It's coming, and that by itself, that trend by itself is reason to investigate private assets.
Yeah. And also to use caution and use services like someone like yourself, because I think there are reasons that that public markets are regulated. There's a history to that as to why that was as necessary as it became. And with the private markets, there's a risk that they're mandatory, their regulations, their laws, and their people who are promoting private investments that have great reputations, and a lot of good things happen. At the same time, like with anything, you can have bad actors. You certainly could in the public markets as well, in spite of all the regulation. So
Sure.
I think, but it's interesting. It is true, Roland. We started talking about the democratization of capital because it is. I worked abroad for many years, and in different countries, you don't have such an ease of wealth building. If, as you say, you're goal oriented and you start with that focus in mind from early on, you can create generational wealth, actually, like in commercial real estate and other kinds of projects. And I mean, that's what an entrepreneur is ultimately seeking to do a lot of the times too.
Mm-hmm.
And I think it's harder in other places where there are higher barriers to entry. And that's what, democratization of capital means to me, is that more people can have the opportunity to start small and grow big. You don't have to start big to grow big.
Right.
So,
yeah.
Well, the other thing I was thinking of, Sarah, is, when you use that word transformation, Carlos, it's such a powerful word and not something that we use regularly. I was at church a couple of weeks ago, and the pastor talked about hope for the flowers, and it's about a caterpillar turning into a butterfly, and the caterpillar completely dissolves inside the cocoon and really becomes a completely different being. But I love that story, and to the extent that you could apply that to the families that you work with. One thing that we've done prior episodes before about qualitative estate planning, and there's this J. Hughes Foundation you may be familiar with that talks about the 5 capitals, and all addressing this problem that, Sarah, you just nailed this on our episode with David that time, that with wealth, it can be almost as much of a curse as a blessing sometimes. And then also it's the shirt sleeves to shirt sleeves in 3 generations problem, that the first generation acquires the wealth. The second generation isn't as connected to what allowed the first generation to achieve that wealth. And by the third generation, there's absolutely no connection to it. And by that time, that's when typically wealth dissipates. So when you talk about something like generational wealth, it's something that has to be very intentional. Carlos, I'd love to hear about what it is that you do with the people that you work with to really enable this transformation.
So it's really, I mean, I can't tell you how many business owners come to us with a $25 million business and $5 million of liquid capital. You know what liquid capital is?
available
It's in the bank.
immediately.
It's in the bank.
Right.
They're liquid. It's in the bank. They're like, yeah, as soon as I get this account up to $15 million, I'm going to sell this business. You know, wow. That's great. I mean, it's very goal oriented, very clear, very simple. And it's like, you know, you're missing out on some stuff. One of it is risk management, you know, and, so it's kind of opening their eyes to, like, you know, you can, get to where you're going a little faster, maybe a lot faster. If you look at adding certain advantages to what you're doing. One of them is tax. I mean, it's always tax motivated, because, I mean, the meeting I've got, you know, in a couple hours is with a client in New York who's got a $2 million income and a $970,000 tax bill every year with that income. It kind of slows you down, in your wealth building. And he's got a family. And so, you know, if he's 60 years old, and I don't remember how old he is, but and his income stayed the same for the next 20 years, you know, there's $20 million of tax going out the door. If we could recoup half of that and send that $10 million to charity when he dies, we can create another $30 or $40 million of wealth for his family. Okay. Generational wealth, plus this $20 million business that he's already got. So, and that's going to grow probably. I was saying, holding everything even, he's probably going to grow it and pay more tax, et cetera. So opening your eyes to, like, results change a lot with some percentage and incremental differences made now. And so that's the first kind of eye-opening conversation. The second kind of eye-opening conversation is what could take you off track? What challenges, risks, or dangers are in the way? And have you planned for those? Because most people don't go out of business because most people don't get to where they want to get to if they don't, they either cash flow changes, something happens to the economy, or something happens to their health. And health is 50% of the time, actually.
Wow.
So it's huge. So many businesses are sold because the owner's health changed. So that's, you know, looking at all those issues, which are not typical for an asset manager, a wealth manager to talk about. We talk about because it's planning in that way that allows for transformation. The transformation starts by the way you see things first, and then it's the way you do things. So that's really the goal. And if they can't see that, that's okay. Maybe it's not time for us to work together. I've had, you know, in my younger years, arguments with potential clients about these issues. And I've got a long-term client, and we talk about the fact that I said he threw me out of his office. She says, no, you stomped out of there mad. I'm like, well, maybe both. But he became a long-term client 4 years later after that bad meeting. And I still manage money for his family. It's, you know, it's tens of millions of dollars. And we helped him all the way through 2 private equity sales and everything. And so it's, I think we were successful there because they're successful. So I hope I answered your question. I may have gotten off a tangent, but.
Well, no, it's good. I mean, Sarah, just so I can jump in real quick. I mean, you care enough that meeting, you care enough about the deal to have a pretty heated, you know, I don't know, argument or exchange with somebody, but it means you care and you're willing to, you know, say, I'm so invested in these principles I'm trying to communicate to you that I would rather lose you as a client, but say what is true than just to tell you what you want to hear, or, you know, and that's, I think, the philosophy that you're describing.
That's right. That's exactly right. Yeah.
Well, Carlos, could we
makes life easier too and better.
What got you into this? Like, what led you in the direction of becoming, a wealth manager or as an investment advisor?
I really started in the business helping mid-market companies, and back then there were public companies in this size frame. You know, there were $20 million public companies all over the place in the 90s. Okay, and helping those companies design sort of reward retention plans for their key people. And that focus was on typically keeping the people tied to the business, as part of the non-equity compensation package, but the non-salary, non-equity package, designing that in a way that helped the company not create a big hole in their balance sheet because they needed to borrow money or needed to report earnings or whatever it might be. And then those same owners asked me to do more and more things for them. And some of them, can you manage this money for us? You've managed this thing pretty well. Can you manage money for us? And I was licensed to do all those things, but I really wasn't building a wealth management firm at the time. I needed those licenses to do what I was doing. And so that's really how that grew. And I got involved in some estate planning scenarios and hated them at first because it seemed like the estate creator was, providing for the kids, providing for the grandkids, providing for the lawyers, providing for the, everybody but himself. And it seemed very unsatisfying. So I started to say, how could we see things differently in this estate scenario? What is a different way of looking at this? And that's when we started adding philanthropy to what I did. And I realized to do this job correctly, I have to have these resources available to my clients, which meant that we still do a lot of compensation work. That's a big part of our business. And the estate work and the asset management now all coordinate to achieve outcomes. And so I realized I had to sort of get, have all those tools to bring to the table to help people really effectively transform how their wealth operates for them and their families long term, and create more of it. Wealth creation is noble. So
yeah. Well, it's interesting because we have talked internally about our legal practice and how, from my perspective, because I worked in the Middle East for a long time, there you have the same exact correlation that you just described, which is founders of businesses, early movers in certain industries end up creating a lot of personal wealth, and then the lines get blended between what's business wealth, what's family wealth, what's personal wealth. And so essentially, even if you're working in a law firm in a corporate finance practice, which I was doing, I ended up doing a lot of what I would call private wealth management related work, because the clients who came to us to do an IPO or to do a private placement or to do a big, take a big syndicated loan from a consortium of banks were the same people who had all of these planning issues and estate planning issues and other investments that were private and, varied. And it was really interesting work to do, especially in the Middle East where you have some complications about succession. Yeah. So when I came here, I was like, why aren't we talking about our practice in terms of something like this? Because I think it's the same thing. It's a little bit of a different flavor of who's starting, but we could say entrepreneurs, private securities, just like you said. Maybe it's not so much the public companies that you're working with here, but private companies here are quite valuable and large. So, and it's interesting because I actually had a conversation with who turns out to be a family friend. I didn't know this because he's my husband's uncle's best friend, but during the conversation, he was talking about how he classifies. He works with a lot of family offices, and there's a sort of, and I think there's a correlation with what you're saying, which is emerging private family offices tend to come out and make sense about the $50 million net worth mark. Mm-hmm. And that's kind of what it sounds like you're talking about too, is how do you get to that, first of all? And then once you're there, what do you do? And family offices can be a solution to that. It's not always necessary. It depends on each individual situation. But I find it really, really interesting that we have this assumption probably that a person who can create that kind of wealth to get to 20 million, to get to $2 million a year in income would automatically know all of these other things to do to optimize all of that. But that's not the case, is what I hear you saying.
Yeah, in fact, they probably know less than a lot of people about a lot of things because they're focused.
Yeah.
I think Buffett said, diversification is a defensive measure. And if you don't know what you're doing, you should definitely diversify. But if you know what you're doing, you're going to be focused. You're going to do the thing that, and so that entrepreneurs are generally brilliant at what they do and lacking in the other areas. And so, they put up filters or, screens to make sure they don't get unfocused. And I think that's super valuable, but sometimes it hurts them too because they don't hear the advice they might be neglecting that could save them millions. So it's sort of a balance, right? For those folks to focus on things like legacy while you're still building your company is difficult.
Yeah.
To focus on tax planning while you're negotiating a deal to sell your business is difficult for some owners. They just can't do it.
It's difficult.
It's just
plain difficult, isn't it? Sometimes without the right guidance.
Yeah. The second time it's a lot easier because they know how much more important it is to save that 20 to 30% on taxes.
Yeah. Yeah.
Well, it just shows the value of people like you and that really have that fiduciary standard. And that was one thing that we were going to maybe try to talk about, is the distinction between an independent advisor and an advisor that's affiliated with a broker. And you made the decision to not be affiliated with a broker, but you were for a long time before that.
Right.
So maybe tell us about what drove that decision.
Several things. When you're affiliated with a broker dealer, you cannot offer anything that the broker dealer doesn't offer to a client. And it's in the broker dealer's best interest to offer things that offer the least risk to them and the most profitability. So, is that a fiduciary stance? I don't know. I don't think it is. The other thing is to be that business is so competitive that the margins are so low that risk management's massive. It's kind of like a grocery store. It used to be, grocery stores used to have 3% margins before HEB kind of figured everything out. They had 3% margins, and one little mistake and their year of profit's gone. Same thing with broker dealers now. It doesn't take much to wipe out a year's worth of profit. So they have to be careful. I get it. And they have to be larger and larger and larger. Well, the larger they are, the more they're going to operate like a large firm. There was a study on private equity a few years ago. It took $1 billion plus deals 20 years out, had returned about 11%. And I was like, well, okay, that's about what the S&P did. So what did you get for that loss of liquidity? $250 million funds that were 250 and that size were averaging in the 25s, 26 range. And so that was a good trade-off, in my opinion. So as you get larger, the deals get less attractive, but they're more democratized in a sense, because so if you're a Merrill Lynch or a Morgan Stanley or whoever, somebody big, you're offering this to a lot of people. And so those returns are watered down. Whereas with us being independent, we're kind of like, you always want to use size on your side. If you're really large, you get to do deals that other people don't get to do. If you're in this mid-market area where we are independent, we get to find deals that are appropriate for mid-market investors. And so what's really great about buying into a $20 million business or a fund full of $20 million businesses is that each of those businesses is very, very focused. They're not trying to diversify. They're not a multi-billion-dollar company trying to diversify and not lose market share or whatever. They're going for it. And so, being this size, you get to see these people are my clients. I relate to those people. Same thing on the debt range, the debt size. I mean, there's some debt programs out there that are very effective for who they serve, but then also for the investors that are investing in them. So I love being in this space. I'd hate to sell. In fact, I've arranged it where we would never lose control of the business, even if I sold, so that if we would keep offering and stay creative and stay in that mid-market space, which I think is where all the fun action is.
We had a conversation with somebody who kind of, I guess you could call him, works in the smaller private equity space. And he, another thing I think that's nice about private equity is in the news a lot, for good or bad. But definitely, I think, as you're saying, in this mid-market range, this is something this is what this other guy did with his fund, is they really made a big contribution to those companies. It sounds like similar to what you're able to do. And so private equity doesn't have to be all bad. It can, like you say, be focused. Those businesses can have, good relationships with the private equity fund that's investing in them. and all of it can be very, let's say, holistic, to use popular Austin word. And
well, yeah. Mm-hmm.
So yeah, just an
I
observation.
mean, yeah, I would add that. So I've gone into companies to talk to them about private equity because most of our clients exit to private equity.
Right.
And before they start talking to private equity, before their opinion is mixed about private equity, rightfully so, because private equity at the large, super large scale, billions of dollars, is oftentimes about the financialization of a product or service or company. It's not about transformation of the value.
Right.
And even large companies go through this internally that are publicly owned, where, in fact, I think I could point this out where many times it adds value, a lot of value. Like Apple's a great example. Company, Steve Jobs did an amazing job. Now you've seen those 10 years where the company's done very, very well, but it's been a financialization of the company. And now you're seeing a loss of the creativity. You're seeing a loss of some sort of what people found it so attractive about Apple. And I think that when you're financially optimizing only and not optimizing for your customers, for your clients or whatever, you might make a lot more money for a short period of time, a lot more. There's sort of like this bubble of growth, but it's sort of marks the end.
Yeah.
And so in the mid-market, private equity guys are coming in and they're turning companies around, or they're growing companies, or they're adding a lot of value and expertise. Yeah. I mean, the very, very best people I know are in the mid-market private equity space. And yeah, they work hard, and yeah, they're tired, and yeah, they're no nonsense people, but they're trying to create good for themselves and for the people. They're actually partnering with the owners to do more, get more customers, more scale, all those kind of things. So I love it.
Yeah, this is exactly, I think, the person that we interviewed before. And Roland, do you remember his name? David, right?
Well, what Wade? Was it Wade you're thinking about?
Well, Wade's another example, actually. So we just actually interviewed somebody who works specifically in the small and medium enterprise area or business. And I think the definition is they help people who have, revenues of as low as $500,000, but they go up to 50 million in their deals. And that was a really interesting space to meet somebody who essentially was like the investment banker to the small, medium business area. And because again, I think it just correlates with what you're saying. There's a need here, and people in that space need to know that there are great services available. They're just perhaps more boutique. So you need to be careful about how you seek those out.
I think that's right. Yeah.
So, well, we're at about 32 minutes. I just briefly wanted to ask you, Carlos, it's so lovely talking to you. But so what, I ask all our guests this usually, but what is it that kind of personally motivates you in this space? I hear your business and your intellectual reasons for it. We've had a great conversation about those, but on a deeply personal level, it sounds like you have a focus on you have service and on achieving good outcomes for the economy. Do you have a way to articulate that for our audience?
Yeah. So, I don't have like a 4-word why that I'd like to. I've thought about that. Simon Sinek stuff is really important. I love all that stuff. But what does excite me is that I win when my clients win. And so I focus on their winning. And my Becca, who was on the call earlier with us, getting this all ready and just takes care of everything here for me, said, we win when you win. She said that to me the other day. I was like, yeah, God, that's great. Cause I was frustrated with something or somebody. And, but that's really it. I mean, and I just, I've always felt like my job was that my calling, if you will, was never to be the entrepreneur with the big business and all those things. That seems neat. It was always to be a support person, to be there right by their side. I've always felt like that's who I was all through life. And I enjoy that place. I feel best there. I feel that's what I'm called to do. And like I said, I want them to win, and I I normally win when they do. And on the other side, I mean, we think about relationships, like we're all kind of in the same, community network, however you want to think about that, right? Um, and I sort of draw lines to make it, these lines are blurry, but I think about terms like network and then community and then partnership. And so the network here in Austin, for instance, or across the country is significant. We are all cordial to each other, but then there's community, people we rely on for those things that that's community. We rely on each other. And then there's partnership. And we try to that's fewer and smaller. It's just more of the inside of the circle. We try to partner with people, both on the providing our services, but also people who help us provide help us build wins, for our clients. And so, I really enjoy that partnership. And one of the distinguishing things about a partnership, though, is that sometimes when your partner wins, you can't win.
Yeah.
You have to take a loss, and that's okay. That's okay. That's different in a network, and that's different in a community. In a partnership, that's the case. But we always stand behind who we're partnering with, and that's really, I really find that to be the motivator. I read a lot of Jim Hughes' stuff in the '90s and after that, and I liked the types of capital. And passing those types of passing one type of capital down without the others may be detrimental.
Yeah.
Giving somebody a $50 million something without the knowledge to operate it is not really a blessing.
Yeah.
You wouldn't give your kid a Ferrari if he was 8 years old, and have fun with this.
Yeah, exactly.
So, I mean, it's a similar scenario. People are doing that all the time, though, and they don't realize it. And sometimes, we have a family, for instance, who the kids are in their 60s, the parents are in their 80s. They want to leave this wealth to the kids in the 60s who don't know how to operate it. So it's okay that you built this. It's okay that you didn't train them on everything, but we can provide some other people that have that other kind of capital, trustees in the sense, so that so your family owns, or at least is renting the capital. Maybe each kid doesn't have it, but this way you have the capital in your family ecosystem, so that this can continue. So I just enjoy those conversations and helping people, helping the light go off, the light bulb go off in the client's head about those things.
Yeah. What was Sarah, I think when we talked with David about David Claflin about this, it was the people that are successful are the ones that are able to turn control over, that are the ones that don't have to control everything themselves, that can find a third party, and they understand this. The 60-year-old kids, they don't understand the business, but to continue this wealth, maybe we have to find somebody that can and can operate this, and that's just where a trusted advisor like you becomes so important, Carlos.
Mm-hmm. It feels like they're institutionalizing sometimes, and they don't want to do that.
Yeah.
But if you think of it in terms of acquiring capital, intellectual capital of some kind, well, that makes sense.
Yeah. Well, and I think, especially with the way the world changes so quick and technology and whatnot, it's also, important to be willing to have some technical expertise come in. So,
right. Yeah.
But it's just, I think Roland and I are sitting here looking at you like, wow, he knows about the 5 capitals. Because we know a few people who know about it. And when we talk about it with others, they understand it. I think we all kind of intuitively, people who think about all of this would intuitively agree that there's more than just the financial capital. But it sounds like you've really analyzed it. And I actually, what you say about hiring in intellectual capital to me is like introducing professional management into which used to be what going public was for sometimes.
Right.
So now we need a different solution for that. And so it's really nice to hear you talk about that.
Yeah, I fell in love with that stuff when I first read it. I thought it was just brilliant.
Yeah. It's to me, it seems like it's just fine. Somebody put a framework on, like I said, like these kind of ideas that you have, like you know, to take the time to articulate it into a framework. Which, by the way, the other framework that you just articulated, or the image for me, with the network emanating from the community, emanating from the close partnerships, is a really lovely image, and I will be using that going forward.
Good. Good.
So.
Well, that seems like a pretty good place for us to wrap up. We don't want to take too much longer, okay. But Carlos, thanks so much for being with us today. It was a great conversation, and it's great to reconnect for sure.
Appreciate it. I appreciate the time with you guys. It's good to connect as well. I look forward to more connection.
Yeah, that would be great.
All right.
Well, thanks everyone for joining us today on Alt Investing Made Easy. We hope you enjoyed this episode. If you did, please like and subscribe to our channel.
And remember, everyone, take aim with your alternative investing strategies.
See you next time.